Ask that question as soon as class gets started, because I guarantee you there are.
Recording in progress.
That's Alan. That's Alan. Set up. No, that's nice. Ah. Yeah, please. My brother. Yeah, Thomas Johnson. Got a meeting tomorrow. You can make it. Yeah, I think I should be able to just take the data. Yeah, just value that. Okay. You have so like you literally copy it's your behind. Sure. The first couple do a filter. Be on the fourth floor. Oh, okay. Big class. Okay. Christian, that's the one that I got. I go back first. I didn't know. So what series is the 3 on, right? Yeah. Did you pass it level 1? Hey, anybody on Zoom, anybody that's logged in via Zoom, let's do a sound check. Can any of you guys hear me? Give me a thumbs up or just chime in, please. It's 10. We're getting no response from anybody on Zoom. So. How's your semester going so far? Oh, it's going. That all is starting to roll. We grow out. I might run. Especially obviously. I'm not getting the greatest. Test. Okay, that's a little better.
Okay, I'm gonna go with that unless I hear differently from any of you on Zoom. Seems to be testing okay in the room here. I get a good response. Okay, good. I got some responses in the chat feature, so thank you. Okay, welcome. If any of you hear that little ding go off, remind me I got somebody in the Zoom room to let in. So trying to figure this out. It's nice to have that Zoom room, so anybody can attend class remotely, but it's challenging from a technology aspect. I did get the first meeting recorded. I looked at a few snippets, looked like we got most of that class. I posted it to YouTube. So if you missed that first class, it's recorded out there. The link to the YouTube site's in the syllabus. Go out there, you can see class from 2 weeks ago. You can see a couple classes from every lecture dating back a couple of years now. If I was having an off night, just go to a different year. Maybe I was having a better night. It's really hard to make some of this material interesting, but I try. Thank you for these cards. Let's see, I got one tonight from Christian. Thank you. This is helpful. I also got Sai, S-A-I, Sai. Is that how you pronounce your name?
Yes.
Thank you. I try to get to know most of you over the course of the semester. Thomas, nice to meet you. Ruth, you had a question. Let's hit that at the beginning of the class. It really helps me out if you all can save your questions for in class, because don't take any offense to this. You all have the same questions. So that usually means that I missed something in class. So Ruth, you had a question about the proxy. Okay, where do we find information for it? Most of that information was in the first class. I kind of went over what I expected. All you really have to do is find the proxy and figure out how your management team gets paid. Did you pick a company to do your research project on? What do you pick? Okay, so if you go to their investor relations site, you'll be able to find the proxy. If it's not there, you can go to sec.gov, but their investor relations site's probably going to have the proxy. Read the proxy and then report back to me on how your management team gets paid. So what their salary is, and specifically what I'm looking for are how their, call it executive comp packages are linked to return on assets. We're going to be looking tonight, return on equity, return on invested capital, share growth, revenue growth, earnings growth. I want to know what those metrics are. So as we proceed module by module through the semester, you can develop just an eye for which of these data points, which of these accounting policies are more likely to get your management team. Really developing that, I guess, skepticism in this class as we go through. Tori's, Matthew, thank you, and Sam. I think it's him. Nice to meet you. So these, thanks again for these. We get to the end of the semester, and you need a half a point to get from a B+ to an A-. It helps if I know who you are. Okay, there was another question somewhere. Yes. Yes, all of the homework and the exams are done on my business course website. You need to get a subscription. How you get a subscription is listed in the syllabus. Click on that link, register through that link, and you're going to get access to our class site. Let's go there now so that if anybody has any questions. This is our class site. So you're going to get access to this website. It's broken down module by module. You can see here the homework assignment for module number 1 is right out here hyperlinked. Click on that, you're gonna get, I think you get 3 to 5 problems every week. Most of them are like problems in nature. The last week I talked a little bit about how they're dynamic. And what I mean by dynamic is that they'll change. So they're not the same for everybody in class. Sam will get different problems than Cy, or actually typically you'll get the same problem, but the software is smart enough to put different numbers in there, so you won't have the same answer. And recall, last time we met, I gave you a guided tour of the Canvas website. And there's a link out there to all of the answers, the key that comes with our textbook. Because the algorithm is smart enough to change those numbers a little bit, you can go out there and look at the answer to those homework solutions. They won't be identical, but the format will be identical. So it takes a little bit to match the question in the book or the question to the homework to the question in the test bank, but have some patience and find it. My experience has been that solves almost 100% of the questions that I have with them. And I'm okay with that because you still get the learning. Going through that exercise is a good exercise for imparting what the authors of the exam or the book are trying to impart through this class. So do that. Any other questions about the homework? Okay, I'm gonna take that to mean everybody found it okay. Pretty simple. Questions were answered. Again, those are designed to be pretty easy points. You go through the effort, you get the points, and the exams are really meant to differentiate the A's from the B's when it comes to corporate. Yes, sir.
Will the exams be similar to the homework?
No, the exams are all multiple choice. If you go out to the My Business Course website, let's see here. Okay, module 4 is our first exam. It'll cover modules 1 through 4. And next week, I'll open that exam. So beginning next Monday night, you'll be able to come out here and click on this exam link right here, and you'll have a 150-point multiple choice test. I think there's 40 questions in there. If you want to get a feel for how those questions are worded, what they test over, click on this sample exam, and there's other study questions located on our Canvas site. So try to gain a familiarity with those before you click on that exam.
We have to come in to take the exam?
No, you can take it from anywhere. And that gives us more class time. So we're gonna move directly from module 4 1 week straight into module 5 the next week. And it's your job to find some time during that. I leave it open for 2 weeks. It's your job to find some time during that 2-week period when the exam is open to take it. And then I'll look at all the scores and figure out if we need a curve. But I feel like I got this class figured out because I've been curve in 4 years. So that's a good thing.
Oh, in terms of, I guess, difficulty and relative to the homework, how would you describe the exams? Because I'm trying to think like that.
The exams are challenging. It's open book, open note, so don't let that fool you. It's a timed exam, and that's the constraint. If your plan is to look up all of the questions on the exam, you will fail. Go into the exam with the understanding that you're going to know about 2/3 of the material. You'll just know it cold, and you'll be able to move through those questions pretty quickly. That leaves about 1/3 of the material that you will actually have time to look up, because you got a 2-hour window of time. You can use your books, you can use the notes, you can use the materials on Canvas. You don't have to know it all. Have a good understanding of the material going into the exam, or you'll run out of time and you'll fail. Historically, the exams have had about somewhere in the low to mid 80s has been about the median exam score. And that's actually pretty consistent with what you see across all classes. Across the whole university. That's okay. I feel like that's a pretty good test of where a class is if I get a median score between 80 and 85. The first exam is going to be a little bit easier than the second and the third. The first exam is mostly review material. Tonight we're talking about return on equity. You've had return on equity somewhere in your course material. You know what net income is. You know what equity is. These are income statement and balance sheet items. But income in the numerator and equity in the denominator, and we'll talk about the components that go into that tonight. But this is review material. So basically, module 1 was prereq for that was somewhere in your management course. Module 2 was basic accounting. Module 3, we're getting into ratio analysis. So the tests on the first exam are a little bit higher than exam 2. Exam 2 is by far and away the hardest because we get a little deeper into the technical accounting. And then 3 is much more related to your finance skill set.
Can you share the slides for our modules?
Yes, they're on Canvas. You can download them directly from our site. And they're available for the exam as well. Well, let me show you. Bear with me a moment here. Here's our Canvas site. If you go to the modules and you scroll down to the bottom, here are all of the PowerPoints in a zip file there. So you're going to download that, double click on that zip file, and you'll get all the PowerPoints. So. Has anybody else had trouble accessing the PowerPoints?
I have.
Okay, so that must be your issue. I don't know how to help with that one. If everybody else is getting them and you're not, that might be an IT issue. Okay. Okay, terrific. I like solving problems. Homework, check. Exam, check. Research reports. We talked about that last week. I've been monitoring all of the messages coming into the Canvas site. Looks like everybody was able to identify a company they wanted to do some work on. And I saw a few duplicates. I reached out. Haven't audited that really closely. So I'm going to ask you again to go in there and make sure that you haven't claimed a company that somebody else has claimed. Because the first person to claim it gets that company. And I have had students get several weeks into the semester and have that oh crap moment. And they have to go back and pick a new company. So just double check that one. And then as soon as you have an opportunity, begin going out to the investor relations site. Somebody asked me about Bloomberg. I reached out to Dr. Clark and he reached out to Nathan. What's Nathan's last name? Yes, Dr. Mock, thank you. And I'm waiting back. Hopefully I will get some good instructions on the best way to access the Bloomberg machine. In the meantime, please click on the other resources video that's located out on our YouTube site. It's going to walk you through all the resources that are available to our class, every class, through the Miller-Nichols library right over here. There are some incredibly powerful databases that will get you jump started on that research project. You want to begin collating all of your information now, and piece by piece, you want to be systematically logging it into your bibliography or works cited page. There's another video on that YouTube site that will show you how to use the works cited tool inside Microsoft Word. If, as you gather these source documents, you just take the 20 seconds that it takes to enter them into that Microsoft works cited page, you're going to find it incredibly easy to annotate this as you're drafting your research paper. Because then you just paste it in, you're going to get a little drop-down menu that gives you all the references. Click on the one that source came from, and you're done. After you get after you get a feel for it, it's really very easy to use. Homework, exam, research report. Ready to jump into module 3. Okay, let's talk about return on equity. And module 3 is lengthy, but it's all review. And we're going to begin talking about how some of our company management teams are measured. I would expect that many of you, if not most of you, are going to see return on equity, return on assets, profit margin directly listed in the incentive comp package of your CEOs and C-suite executives. So as we break this down, be mindful of what goes into each of these ratios. And then I'm gonna ask you to drill in on that a little bit throughout the semester as you create your research report and executive summary, identifying the talent of your management teams and the decisions that they're making with regard to the accounting. So as I mentioned, return on equity should be a fairly familiar concept for everybody in the room. We're simply taking net income divided by average stockholders' equity. And as is the case with all of these modules, I'm going to move pretty quickly through the slides that are review material. If anybody's having trouble with anything that I'm glossing over, that might be a little bit of a pink flag. Seek help sooner rather than later. So our authors give us a good little viewpoint into what you can expect from return on equity. That average range for companies in the S&P 500 has been 13.5% to 15.6% over 2014 to 2018. And it climbed throughout that period. The specific example that we get in the text is Boston Scientific. We get income statement data in the form of sales. We get income statement data in the form of net income, obviously. And we're going to divide that by assets if we're calculating return on assets, or equity if we're calculating return on equity. Notice here that our authors are using an average equity in the denominator. Why are we using an average equity in the denominator? Now I have cards so I can pick on you. Sam. you were on top. You were on top. Sorry, my friend. I'll help you out. It's a period of time. So we were trying to calculate return on equity over, what is this? 2018. So time has to elapse for us to know what our return is. Then net income happened over a period of years. So we don't want to use a 1-year number in the numerator and then a year-end number in the denominator. So we use an average. Technically, that's more accurate. The problem arises is that you don't normally see it in practice. Analysts being, well, I'll just use myself as an example of an analyst, are lazy. And I am a very good example of a lazy analyst. So depending on what your use case is, if you just want to take a swag at return on equity, most of the analysts I see just use the year-end number. Net income over, that's income over equity. There you go, boom, return on equity. And as long as your company didn't go through a major merger or acquisition or divestiture, equity doesn't change that much from year to year. That's fine. Remember, the whole field of finance is based on crunching numbers for the purpose of making a decision with regard to internal operations, mergers and acquisitions, investment banking. We're using everything that we do for some purpose. And as long as the way you calculate the ratios helps to accomplish that purpose, well, then you can take some liberties with the way that you actually put these into practice. Now, when it's time to take the exam, use average. But when you get out into practice and you're trying to figure out why the report that you downloaded from Morgan Stanley or Goldman Sachs or Bank of America doesn't match this, it's because they're using shortcuts, and it happens all the time. And when when you've graduated and you got your own job in the industry and you want to take some of those shortcuts, go for it.
You ever, so if they would have given you that income from the 2017 as well, would you do the same for the top, or is it just for year end of the current year you're looking?
It's just for the denominator that you would use average, because the top is already representative of a 12-month period of time. That's the income statement. The denominator is balance sheet data. Balance sheet data is always a snapshot of a single date, usually 12/31/2022 or whatever the time period is. You're going to get a snapshot of the company on that date. So in order for those two things to match, we have to take an average of the beginning of period and end of period, and then you got some semblance of comparability between the numerator and the denominator. Okay, let's break this down. Let's look at the components that actually go into return on equity before I flip to the next slide and give you the answer. So break this down from a conceptual level. Return on equity is going to include. Anybody want to take a stab at this?
Return on assets, it's a product of return on assets and financial.
Okay, you're way ahead. I'm guessing that you probably read the text in advance, so you and I have nothing in common. I would never come as prepared as you. I'm impressed.
I made note that I'm back from the schedule, so I'm trying to catch up. I got ahead.
Oh, well done, well done. That's exactly the formula for passing this class with flying colors. Keep it up. And you're exact. When you look at return on equity, the breakdown, and this is called the DuPont formula. Professor DuPont, I forget where he was, I forget where he taught, but he was the first one who broke it down and put his name on the formula. So you're going to take net income over average stockholders' equity, and you're going to split that into two components. And we'll break these two components down into multiple components. But firstly, you have return on assets. Think about return on assets as, well, the return of the business. So back to your basic balance sheet. Let's break down the balance sheet equals assets equals liabilities plus equities on owner's equity. When you launch a business, car wash, lemonade stand, apartment building, whatever it is, the owner is usually going to strike a check to buy the car wash. Maybe they can't afford it all. Maybe they go to the bank and borrow half of the money. Well, you got owner's equity that he or she ponied up themselves, some money from the bank. That's all your cash. Take that cash, you buy a car wash. That's the whole business. Assets equals liabilities plus owner's equity. Now, return on assets is the return generated by the assets. And when I say the return on the business, that's return on assets. That's the net income generated by all of the productive capacity of that business. When you think about compensating your management teams, return on assets is usually a fairer judgment of how well they're operating those assets. Because to a certain extent, it's Andy Reid's job to get the most out of the Kansas City Chiefs football team and optimize the performance of those assets on the field. Same way with the CEO that's running your company. He or she has been vested with all of the assets, sales force, property, plant, equipment, brand, you name it. All of the assets that show up on the balance sheet are now at his or her disposal. And it's their job to organize them in such a way as to optimize net income. That's return on assets. So when you all are employing your first CEO, now you're out in the business world and you've had this your success story and you want to hire a CEO, somebody to come in and run your business. I would encourage you strongly to look at return on assets as one of the primary incentive tools and measurement tools by which they would be judged. Here's the problem. I don't know, problem, but too cynical. The other component of return on equity is financial leverage. If you take a business that is otherwise financed 100% with equity, meaning that you wrote the check, you reached into your wallet, you financed 100% of those assets. Then you go to the bank and you borrow a little bit. What's going to happen to your return on equity? Well, through just the math, if you just look at the calculation of the return, it's going to increase because you're going to borrow at 6% and you're going to invest in assets that are generating something higher than 6%. If that weren't true, you'd never go to the bank and borrow anything. If you can borrow at 6% and put that money to work in assets that are generating 10%, then your return on equity is going to be higher than it otherwise would be if you just financed it 100% with others. There's a problem. So I view that as one of the problems in business, because if you compensate your CEO on return on equity, after they've done everything else that they can think to do, to run a good business, a profitable business, to maximize the cash flows coming out of those operations, it's very, very tempting to just want to add a little debt to the business so that they can increase their return on it. So think through this one. When you're reading your proxy, if any of you come across the scenario where your CEO or C-suite is compensated with return on equity, what do you need to be mindful of next? You need to be mindful that they're not just increasing the leverage of the business so that they can in turn increase their return on equity. So that would send up little pink flags. If I knew my CEO was compensated based on return on equity, and year after year after year after year, I saw that CEO taking on more debt, that's going to increase the return on equity, while simultaneously adding more and more risk to the business. How much debt is too much debt? Who's next? Oh, Matt, you're right on top. How much debt is too much debt?
Enough debt that you can't pay back. Your requirement.
That is the straw that breaks the camel's back, right? You don't know how much debt is too much debt until you can't pay it back. Spoken like a true CEO. Well, let's just keep this train going. We've been able to pay it back so far. Let's see if the bank will loan us some more. I've played that game before. And I'll very oftentimes the bank will loan you more, because what is the bank in the business to do? Loan you money. If the bank doesn't loan you money, then the bank goes out of business. So the bank wants you to be both credit worthy and a good borrower. The bank always wants you to borrow more money, but they want you to do it in a healthy way. Well, I guarantee you, every sales rep at the bank gets paid on loan issues. So it's not hard to find somebody at the bank that wants to make you a loan. As a CEO, you have to balance the risk that you're taking onto the business, and how much debt is too much debt usually requires a careful study of stress tested environments over time. So look back at how your company, your research project fared in the last recession. Go back to the Great Recession, because COVID didn't count. COVID was a technical recession that lasted for about a month until most of the United States and the world really got bailed out. It didn't stress test anybody's business. The Great Financial Crisis in 08-09 stress tested everybody's business. And if you had debt on your balance sheet that you needed to refinance, you were in big trouble. So how much debt is too much debt is usually determined by the cash flows of the business. you have good visibility into your cash flows, if you have long-term contracts, if you have monopolistic pricing power, if you have supply relationships that are multi-year, those are the type of conditions under which you can safely take on more debt. So if you look at the S&P 500 and some of the companies that are members, waiting room one, admit. You'll see businesses like utilities have a higher financial leverage ratio. Well, that makes a lot of sense. One of the last things that any of us in this room are gonna not pay is the electricity. Whereas companies like retailers, maybe that's a, it's a very easy thing for retailers to miss a fashion season and not be able to cover their inventory as some of that goes out of fashion. Same calculation for return on assets here shown on slide number 10 by our authors. Net income in the numerator, average assets in the denominator, Boston Scientific at 8.35. You'll see that return on assets generally somewhere in the mid-single digits. Now you're going to want to cross-reference that against your specific industry, and you're going to want to cross-reference that against a peer group. So if you're General Motors, then your peer group is going to be Chrysler and Ford and Fiat and Toyota and the other automakers. And if you're in some tech group, you're going to use some tech peer group. The next question that I want you to answer in your research reports is, if you're Ford and you have a return on assets of 5%, and you're comparing that to GM with the return on assets of 7%, you need to find out what the difference is. And you need to drill down until you can attribute that to some strategic positioning on behalf of Ford or GM. So you might find that that's due to Ford's sales mix being significantly weighted towards the Ford F-150, which is their best selling car and highest margin car. And I don't know what Chevy has to compete in that, or GM has to compete in that category. That's just, you might find that it's due to something else like overseas sales, or you might find that it's due to better tax treatment or more electric vehicles. It's your job as the analyst to figure out why that is. Okay, I talked about return on equity being a breakdown of return on assets and financial leverage. This is how you calculate financial leverage. Total assets in the numerator, and then in the denominator, you're going to see average again, stockholders' equity. Really what you're getting at there is the percent of the business that's financed with equity. The more debt you have, the higher the multiplier is going to be as it relates to return on equity. Okay, some technical points when it comes to calculating return on equity. Generally, when we're talking about return on equity in this class, or any multiple for that matter, we're talking about that multiple as it relates to common shares. And therefore, we have to subtract out preferred shares and preferred dividends. So again, this is a technical point, but because we're taking the position of a common shareholder, which is the whole point of our research project, we're trying to value the common stock of a company, figure out how much that common stock is worth. When we calculate return on equity, we want to take net income, subtract preferred dividends, and then we want to divide by average stockholders' equity less average preferred equity. And that's a good example of a type of test question that you might see. Authors like to test the more technical components of the class. So just be mindful of that type of thing. Okay, here's another nuanced point. Some of you will see on your balance sheet line items that reference net income attributable to non-controlling interests. So if you're looking at a conglomerate or I guess conglomerate, a company that owns another company, it's very common for a company to own something less than 100%. If you own less than 100%, that means that there's some other minority shareholder, maybe they own 5%. That would be a non-controlling interest. So we have to reconcile. So we have to look at the income statement and look at the balance sheet and figure out whether or not we're calculating the return on equity for the controlling interest or the non-controlling. If it's the non-controlling interest, then you want to look at the net income attributable to non-controlling shareholders. It's the controlling interest, you want the net income attributable to company shareholders or oftentimes just common shareholders. We'll talk about that more and the accounting for that more later in the semester. Okay, let's drill in a little further. Now let's take return on assets and break that down into profit margin. Profit margin is pretty simple. We just want to know how much they're making on every widget that we sell. So we'll take net income. What do we actually make for each dollar worth of sales? And then we're going to multiply that times a metric that we call asset turnover. So how many widgets do we produce for each dollar's worth of asset do we have? We multiply both of those terms together, we get return on assets. So as our return on assets fluctuates from year to year, or if we're comparing GM to Ford, or if we're comparing company A to company B, and there's a discrepancy, one of the first places that we want to look is towards this breakdown. Okay, now we know there's a difference. The question is, why is there a difference? Okay, let's get a little different. Maybe the profit margin is identical. Let's use that Ford GM example that I just threw out there. Maybe Ford and GM have an identical profit margin. Well, that's going to inform us that the difference has to be in asset turnover. Well, that means that Ford is getting more trucks churned out of their factories per dollar's worth of sales than GM is. They're more productive at turning over those assets. That's probably a really good hallmark of a good management team or a company that has organized themselves to be more efficient than their peers. That would be a great sign of a company that I would want to invest in. Yes. I think that covers all the points on that slide. Star this slide. This is the key of the whole DuPont method breakdown. You can drill, you can keep drilling, and you can drill some more into all of these terms. And these are the ratios that you're going to be left with. Net income divided by average equity on the top. Return on assets breaks down into profitability. That's net income over sales, divided by productivity, which was sales over assets. Well, you can break that down into, well, which assets are we talking about? There's accounts receivable, there's inventory, there's accounts payable. We can calculate the cash conversion cycle, which we'll look at here in a moment. And then we have property, plant, and equipment turnover. Profitability breaks down into gross profit, operating profit, net profit, and then financial leverage has a couple of ratios underneath those. As it relates to your research projects, I want to know what every single one of these ratios are for the companies that you've chosen. I want to know how those ratios, every single one of them, compare against their peer group and industry. And I want to know how those ratios, every single one of them, have trended over time. So I want you to be able to tell me if this year's number is higher or lower than last year's number and why. And really, I want you to be able to do that over the last decade. Because the big part of the value in going through that exercise is to see what those ratios did during an economic expansion, what those ratios did during a bull market on Wall Street, what they did during a bear market on Wall Street, what they did during an economic recession. You never really know a business until you've been a part of that business during a recession. And fortunately or unfortunately, most businesses have not seen a real recession in over a decade. And I mean, that's a really good thing. The economy has been incredibly strong over the last decade, but it worries me that a lot of corporate America may not be prepared for a protracted decline in GDP growth. Okay, the next 5 or 8 or 10 slides go through all those ratios. The most important part of those ratios and the whole class is understanding what they mean. And this slide is a pretty good example of breaking down the analysis of profitability. And I love those 5 bullet points on the screen. When you see those ratios trend over time for the good or for the bad, there's a handful of reasons why that might be, as the competitive intensity business. Example, happens all the time in industry. You see more entrants come into a particular industry and profit margins. Product line has lost appeal. That's the retail example I gave just a moment ago. Product costs have increased. Well, every company that it's experiencing that right. Product mix has changed. When we talk later in the semester about product mix and the modeling of that, we'll look at companies like J&J and Procter & Gamble that have half a dozen different business lines, all with their own unique profit margins, and those they can get very, very beyond the scope of this class, but I'll share what that looks like with you later in the semester. Volume has declined, fixed costs have not. This is the type of intensive analysis that we'll touch on later in the semester. I just pause on it here to make sure that everybody has an awareness of where we're going and conceptually what we're after. Nothing on this chart that's new, except for this graph of the S&P 500 operating expense margin. So operating expense margin in the first bullet, there's the definition, measures general operating costs for each sales dollar. So in 2009, operating costs were 19% of revenues for the S&P 500. And you can see that moving into 14, 15, 16, really beginning in 13, you start to see operating expense decline significantly as a percentage of revenues. What's that mean? Well, expenses are declining. What's happening to profitability? Profitability is going up. Companies are getting more and more profitable. What was going on during that period of time that allowed for companies to get more and more profitable?
Automation. Due to automation, their operating costs decrease.
Yeah, automation, technology, interest rates were declining. We were in a boom period of economic expansion that generally gives companies a little bit more leverage with their workers. We were not seeing workers' salaries appreciate during this period of time. That's kind of reversed itself. If you look at really anything post-COVID, so 20, 21, 22, this has changed dramatically. This line has reversed. I just say all that to try to give everybody in this room some context, because the financial analyst has to have some wherewithal about them to recognize what's going on in the global economy if we're ever going to expect to know and draw insights about what's happening to some of these ratios. Okay, let's talk productivity. I'll give a brief tour of each of these ratios. Again, calculate these for your own target companies and peer group and industry and history. Asset turnover, we already talked about that, sales over average assets. We can calculate turnover in several different ways. The linkage, whenever we're talking turnover, is to put an income statement item in the numerator and a balance sheet item in the denominator. And you can see we do that with accounts receivable turnover, inventory turnover, accounts payable turnover. It gives us some measure of how efficiently we're operating each one of those assets on the balance sheet. And we want to do that systematically. We want to take the balance sheet, we want to look line item by line item and ask ourselves, okay, how efficiently are we deploying this specific line? How's management doing on property, plant, equipment, accounts payable, accounts receivable? And we have ratios that we can look at in each of those categories that are going to help us come to some conclusion about how well we're doing. And those start right here with accounts receivable turnover, inventory turnover, and accounts payable turnover. So look at the first one there. Accounts receivable turnover is sales over average assets. We can take that same ratio and calculate it just a little bit differently here. If we take 365 days in a year and divide by accounts receivable turnover, we get something that we call days sales outstanding, which is going to tell us on average, how much time does it collect this? How much time does it take us to collect on a sale when we sell it on credit? Well, if we take days sales outstanding, which is right here, DSO, and we add that to days inventory outstanding, which is inventory turnover divided into 365. And we add that to days payable outstanding, which is accounts payable turnover divided into 365. That's going to yield something that we call our cash conversion cycle. And think about the cash conversion cycle as like the heartbeat of your firm. How fast does it take to turn cash back into cash? So you have cash. First thing you do with cash is buy inventory. You got to buy all of your raw materials. Those move into work in progress. Work in progress moves into finished goods. Finished goods moves into retail. Retail moves into accounts receivable, and ultimately accounts receivable is collected and you have cash. That whole process is called the cash conversion cycle. And if you add up the days sales outstanding, days inventory outstanding, and days payable outstanding, you'll get a number that, call it 50 days. And it's going to vary by industry. So kind of have some idea of where your industry is, where your peers are. We use that Ford and GM example again. Ford has a cash conversion cycle of 50 days and GM has 75. You're going to need to know the reason why. One of the obvious reason why is that one reason why might be that GM has much more favorable credit terms. They might have 0% financing and no payments for 6 months. Well, that's going to dramatically extend their accounts receivable outstanding, days outstanding, which would easily explain that. Now it would have to translate into more sales. If they're giving away those generous terms and not yielding more sales, then they need to reevaluate what they're doing because they're probably not competitive with some of their peers. Here's a good example of that cash conversion cycle and how it varies by industry. You can see healthcare there up over 100 days, which is, I suspect, consistent with most of our experiences here. Utilities, they get paid on time or they're going to shut you off. They have a little bit more supplier power in that formula. If you go back to Porter's 5 forces, the bargaining power of suppliers and the bargaining power of not supplier, but can't think of the word. I'm grasping for the word I want. Competitors. Yeah. Feel free to help me out at any point. Okay, I want to point something out here. Thought it was on the next slide, maybe I missed it. Oh, here it is. The cash conversion cycle for Apple. This is highly unusual. The days sales outstanding for Apple is 28.2. Days inventory outstanding is 9.8. Those are both good numbers. The days payable outstanding is negative 111.6. How do you get a negative days payable outstanding? And it's only Apple that has the competitive heft, I guess, and power to do this. Pre-orders are part of it. And the key there is that, well, no, that would be, take that back. Pre-orders would be the day's sales outstanding, because those go into, that's a sales number. This days payable outstanding would be Apple paying their suppliers. So their original equipment manufacturers is the relationship that would affect this number. So it'd be like their chip suppliers. Let's just break it down into one individual supplier, and we'll say Qualcomm. So Apple and Qualcomm. How is it that Apple's days payable outstanding can be a negative?
If they had been 111 days in advance of when they would actually owe said money to them.
Maybe. Let's walk through that and see if we're saying the same thing. So Qualcomm gives the chip to Apple. Apple doesn't pay Qualcomm. Apple puts that chip in a phone. Apple sells that phone to somebody like myself. I pay Apple $1,000 for that phone. And then after that sale has been made and Apple's collected that cash, that whole cycle takes 111 days. Qualcomm gets paid. Apple says, if you want to sell us equipment to put in our iPhones, get in the back of the line. We'll pay you after we build the phone, ship the phone, sell the phone, finance the phone, collect the cash, and then maybe we'll pay you what we feel like paying. Nobody has that kind of power except for Apple. I've never seen a cash conversion cycle at negative 73 days. That's very remarkable in business in general. And it takes us right back to module 1 when we're looking at those Porter's 5 forces. When you see something that unique, that's a company that's really built something special. You just don't see that every day. This is worth putting some thought into how any company in the world could put themselves in a position of just having that much power with their suppliers and consumers. Okay, there were 2 leverage ratios. We already talked about liabilities to equity. How much debt is too debt? How much debt is too much debt? I threw that question out there a few minutes ago. Times interest earned is a key ratio for a lot of bankers. When they're looking at the credit worthiness of your business, oftentimes they'll take this ratio into consideration. Times interest earned is what it sounds like. The banker's going to look at your net income, and they're going to actually earnings before interest and tax is the numerator. And they're going to divide that into interest expense. So if our earnings before interest and tax is $1 million, and our interest is 100,000, times interest earned ratio is 10 times. How does that make you feel as a banker or anybody that's loaned another business money to finance their operations? The higher the better. Okay, so if the number is 10, how do you feel about the likelihood you're gonna get? Feel pretty good. I feel pretty good. They have some coverage there. I feel a lot better than if the number were 2 or if the number were 1.1. This is a great ratio to know for the companies that you work for. It's going to give you some indication of how leveraged they are. It's going to give you some indication of how much margin they have before there's any danger that they might not be able to stroke your paycheck in 2 weeks. So very common with bankers. They pay a lot of attention to that number because that's how they get paid. I want to talk a little bit about adjusted return on assets. We use net income for the return on assets calculation. Net income is net income. That's the bottom line. It's actually not. There's something called comprehensive income, but we'll pollute our minds with comprehensive income later in the semester. Because net income includes interest expense, there's an argument that can be made by many analysts that we should factor that out. Because if we're just looking at the return on the assets of the business, we want that financing decision that's associated with that leverage ratio we just looked at. We want that to be separate, independent, and distinct. How much debt a company should have should be decided by the CFO and the board. How the company operates, those decisions are made at the president level, chief sales officer, CEO level. That's how we organize that. Deal with the most we can make them do. So we can factor that out. We can take the net interest expense and okay, so we can take the net interest expense times 1 minus the statutory tax rate. And that's going to allow us to remove that from the numerator of the equation over here. Let's see if I can get a simpler example. So our adjusted ROA becomes net income plus that interest expense, but we have to tax affect it because interest expense is a tax shield. Any expense line item that shows up on our income statement directly reduces the amount of tax that we pay. So if we're going to add back the interest expense, we simultaneously have to reduce that for the tax shield. The formula for calculating that tax shield is 1 minus the tax rate. So all of those values go into our numerator. Average assets is in the denominator. And that adjustment for Boston Scientific becomes 8.68%. These are the types of adjustments that we're going to be hitting on week after week after week, all semester long. And after about module 4, when we start breaking down some of the accounting treatment, they're going to begin to get more and more complex. And it can a little bit, well, it just feels like a grinder, constantly adjusting the financial statements to make sure you have an apples to apples comparison between accounting. And I understand the technical drudgery of doing that in this class. That's where I say some of these lectures are they're just challenging. It's challenging to make it interesting. But I guarantee you that when you get out there into the real world and you're working for like Apple, if you can shave even a fraction of a day off their cash conversion cycle with the billions and billions of dollars that they're working with on an annual basis, you can recreate your salary 100 times over because the numbers get so big. So if you want to bonus yourself from $150,000 a year to 200 to 250 to 300, shave a quarter of a day off Apple's cash conversion cycle, and you'll have more than a sufficient argument to walk into your manager and say, I found you a quarter of a day. Treat me right, come bonus time. Okay, let's see here. Analyst adjustments. Sometimes the return on equity needs to be adjusted. When companies buy back their own stock in the market, happens all the time. And this is another trick. If your CEO gets paid based on return on equity, one of the easiest ways to boost your return on equity is to embark on a company stock buyback plan. Because company stock buybacks directly reduce the equity in the denominator of that return on equity calculation. These are just financial shenanigans. It doesn't take any brain power to embark on a stock repurchase plan. But if that's how your company wants to pay you, if they want to tie your incentive comp to return on equity, why wouldn't you do that? It's gonna increase your bottom line. It's not necessarily a very shareholder friendly maneuver, because from an academic standpoint, you would want to buy your own stock back when it's cheap. So if you're the single shareholder, and I love to hold Warren Buffett out as an example of a good steward. Part of the reason he's such a good steward is because he owns so much of that business. He thinks like an owner, he behaves like an owner. He would never buy his own stock back unless he genuinely felt like it was a good deal for him and the rest of the shareholders, because he owns such a large percentage of that business. But in another business where the CEO owns a fraction, if anything, well, buying stock back at any price makes sense to that CEO, because he or she has their compensation linked to return on equity, and it's a maneuver or a shenanigan that allows for a return on equity to be manipulated. If you see equity values very, very small and or negative, stock buybacks are oftentimes the reason. That is the case for any of the companies that you're working on. One common adjustment is just to add back all that treasury stock into the calculation of return on. And again, we're analysts, we're taking shortcuts, we're trying to make this data work for us so we can make informed decisions. These adjustments are they're estimates, they're tools. And this is a very common one that you'll see analysts use if that return on equity number goes negative. We do it on time. I got 10 minutes to get through 40 slides. So let's do the lightning round here. Put on your seatbelts and we will cruise here. Okay. There's really only one big concept that I need to touch on with the back half of this deck. And it's the distinction between operating assets and non-operating assets. Very, very common for your company balance sheets to have a whole bunch of assets listed that are no longer relevant or germane to the ongoing operations of the business. Some companies get into bad M&A activity. Some companies get into other little conglomerates that go nowhere. Some companies get into financing arms. There's another dozen reasons why you might end up with assets that are non-operating. And they're assets, they're worth something. They're just not deployed on a day-to-day business, on a day-to-day basis in the operations of the company. So what we want to do is adjust. And the way we go about adjusting for that is to differentiate operating from non-operating assets on the balance sheet. And unfortunately, I get this question every semester, which is, how do I tell the difference between an operating asset and a non-operating asset? And there's no great way to go about doing it. there's a couple of slides in our book that differentiate operating from non-operating for Boston Scientific and a few other businesses. But when you all go to look at the balance sheets of the companies that you've selected to work on, those balance sheets, some of them conform to gaps. And as you know, gap can be pretty flexible. Companies have a lot of leeway in how they describe the assets that end up on their books. The only true way to know whether an asset is operating versus non-operating is to truly understand the underlying business that you're working. Scientific, and you have a lab that makes heart stents in the Philippines. That's obviously an operating asset. Heart stents are one of Boston Scientific's biggest businesses. When you have a patent portfolio that you've invested in over the course of the last 20 years, that's just sitting on the shelf doing nothing, you might argue that that's a non-operating asset. That's more akin to an investment, like just like any hedge fund manager or portfolio manager would make on behalf of their clients. It's common for healthcare companies to do the same thing. Now, if that patent portfolio that's been sitting there for 20 years, if something about the way genomics work or biotech or something unfolds that makes that patent portfolio go up in value by 20%. Is that a scenario that we as shareholders want to compensate our CEO for? For the sake of argument, let's just say no, that CEO did nothing to increase the value of that asset. So we would be wiser to link that CEO's compensation to return on net operating assets. These are the assets that operate. These are the assets that you can control. These are the assets that we're hiring you to manage. And therefore, we're going to link your comp to return on net operating assets. In order to do something like that, we have to be able to identify the difference between operating and non-operating assets. And that's what the back half of module 3 is all about. And here's an example. In red, we have all of our operating assets. Cash is a great example of a non-operating asset. Apple, it's been a few years, but Apple, which now pays a dividend, used to have, I think it was close to $250 billion worth of cash on their books. And the question that you all have as analysts is, what are you going to do with that cash? Why is it just sitting there? Why not return it to shareholders? Are you using it for M&A? Are you using it to launch new facilities to manufacture phones? What are you doing with $250 billion worth of cash? It's a testament to how, again, how powerful Apple is that they were ever able to generate $250 billion of cash in the first place. And now it's just sitting there. So if we want to look at the ongoing profitability of the business, we want to differentiate between operating and non-operating assets so we can calculate the return to operating assets. Because if you require a return on all that cash, that's significantly going to drag down the return on the business. And maybe that's appropriate. Maybe that's appropriate because sitting with all that cash doing nothing with it. I mean, come on, guys. Get a strategy, deploy it, or return it to shareholders. So take a look at these slides. They're going to give you an example of what's operating, what's non-operating. And then we can calculate the net operating profit after tax equals the net operating profit before tax minus the tax on operating profit. Almost exactly like we added interest expense back a moment ago when we adjusted return on assets. We're going to add the tax on operating profits back here in a similar manner. So we have net operating profit before tax equals sales less operating expenses. You see operating expenses defined there. Slide 47 defines that tax shield exactly like we looked at a moment ago with adjusted ROA. We get pre-tax net non-operating expense, identify the tax benefit, and we have just calculated no pet. Okay, the very high level, but conceptually, that's what's going on there. Then learning objective number 6, compute and interpret return on net operating assets. The return on net operating assets is just a simple formula. After we've identified the difference between operating and non-operating, we have average net operating assets, very similar to the DuPont formula. The only real challenge here is in the identification of operating versus non-operating.
So does that become discretionary? Like by analysts then? What they consider when looking at a company, what they're operating versus not operating? That
Yeah.
sort of stuff?
Yeah, you'll find in looking at several of those slides that our authors have tried to make it a little bit easier on us. So we know cash is always a non-operating. There's a few others in there. As you familiarize yourselves with those, you'll get a similar breakdown. So you'll be able to identify those for the homework and the exams. And generally speaking, most analysts adhere to that template. But when you're out there in practice, yeah, you'll see a lot of it ends up at the discretion of the analyst. And then that's okay, because it's usually not that material. Usually most of the material items are fairly commonsensical. Objective number 7, disaggregate return on net operating assets into net operating profitability and net operating asset turnover. Again, this is exactly like the DuPont method. We're just coming at it from a little bit of a different angle, so I don't need to touch on that. Some good detail later in that deck. And I think that about gets us there. I think there was maybe one slide at the end I didn't get to talk about. Okay, here it is. Learning objective number 9 talks about common size financial statements and horizontal analysis. Oh, doggone it. Doggone it. My daughters would be making fun of me right now if they heard me say doggone it. Common size financial statements are a very easy thing to calculate. I don't have an example in the slide deck. For sure, authors gave me an example here, so I'll try to find one and see if we can touch on it next time we're in class. But if you look at the net income statement, you're simply going down line item by line item and looking at everything relative to sales. So you have sales relative to sales is 1. And you have accounts receivable or cash, or on the income statement. So you have cost of goods sold as a percent of sales, and then you have your operating margin and everything else on the income statement relative to sales. And if you look at that trending over time, you see that gives you some insights into the proportionality of one income statement as compared to the next. Horizontal analysis is that over time comparison. I'll see if I can't find some better examples of that for next time we meet. We will meet in class in 2 weeks. Next week will be an online lecture. I will open that exam and send out an announcement to the class when it's open. You'll have 2 weeks to take it. Reach out to me with any questions. What did I miss? Anything before we adjourn? Okay, thanks, Ken. Appreciate your time. We did have a question.
We is it enough materials to take that to the kind of way, or we do?
Well, I'll give you the answer that I give everybody trying to get an A. Read the book, listen to the online e-lectures, listen to the YouTube lectures, take the practice exam, and do the homework. You do those 5 things, you're going to get an A in class. That's not the model I used when I was in undergrad. how I personally would take this test is I would come to the first 3 classes and I'd do the homework because those are real points. And then I'd take the test and see how well I did. And if I aced it, well, that's probably all the further work I'm gonna do in this class. Because I don't wanna do more work. I wanna do less work.
We only get one attempt at the quiz.
You only get one, you get as many attempts as you want on the homework, and you get 1 attempt on the quiz.
The time to do that. Like,
You get 2 hours. And you can take it anytime within a 2-week period. Yep. Thanks all. Eric, nice to meet you.
Nice to meet you.
Yeah, appreciate it. Having you in class.
Yeah, it's good class. Thank you. Picture on there.
Hey, right on. That's gonna help. Jaden, appreciate it. I will try to commit that to memory before the end of the semester. All right, take care. Okay, this is the first assignment on the syllabus. It's name, hometown, major with a picture, so I can try to get to know you. And this tells me a little bit about you, and it's on the syllabus. Everything you need is right there on the syllabus. Okay. Matt,
So super high level review of this, because I turned it in on the canvas as well. So this was my proxy that I built, or my analysis for the proxy. Is this kind of heading on the right track for it?
yep, so what is your incentive comp plan linked to? So you got 2 categories, short, long-term, 3-year cycle. Annual incentives are
Cash based only.
cash only. Long-term incentives can be both cash and equity. Short-term, 26, long-term.
That's for the total incentive package. 6 and then 73.
So 3-part weighting between 50% PSUs. What's a PSU?
Performance stock,
And that's linked to equity.
yes.
Okay, so 50% of their incentive comp is tied to PSUs, which are linked to the equity. So your management team has a big incentive to drive that stock price.
Right.
Okay. The conflict of interest is going to arise in the time horizon. So your management team has incentive comp that they want to see go up. And if you were going to manipulate that, you would make decisions that drove the stock price up in the short run at the expense of decisions that
In the
drive
long
the stock
run,
price up
okay.
in the long run. And a good example of that would be plant maintenance. Like anything, like if you're Southwest, stop doing the maintenance on a bunch of your planes. You're going to drop a whole bunch of money into the bottom line immediately.
Okay.
That's going to drive that stock price up. Now, and if you're the CEO and it's your intent to retire in 3 years, that works great.
Got it, okay.
But that's a terrible strategy
Right.
for running a company like Southwest for the next decade.
Right, okay. That
So
makes sense.
that's part of the conflict of interest that you're looking for there.
Okay,
PSU is generally pretty good because you're tying it to the stock price. You like that,
right,
but it's not the same as real equity.
Okay.
If
That makes sense.
it were real equity with the vesting schedule that took 3, 5, and 10 years. Well, now you're incentivizing the management team to think like a long-term shareholder.
got it,
Right?
Okay.
I like that.
right.
Okay, so you got it. Yeah, you're piecing it all together here.
Okay.
Anything like return on equity, return on assets, any specific accounting measures, or is it all RSUs, PSUs,
And then-
LTIPs?
And then these two are pretty similar.
Mhm.
So they don't grant the options to the management team. Now, the directors, the board, they have an option to receive either cash or they can defer their cash into straight stocks. They
Okay.
also require their board to then carry so many stocks equal to, I believe it was 5 or 10 times the amount of cash that they're receiving.
Okay, I'd say on the whole, you have.